Welcome to this explainer. Okay, today we're breaking down the incredibly high-stakes variables heading into CrowdStrike's highly anticipated June 3rd earnings report. If you follow cybersecurity at all, you already know CrowdStrike is an absolute bellwether. Reporting right after Dell and just before Broadcom, this is the print that sets the tone for the entire sector early in the cycle. So we're going to completely unpack the tension, the massive expectations, and the lingering risks surrounding this specific Tuesday after the market closes. Let's get into it. The sheer momentum here is honestly staggering. We're talking about a stock that surged 41% in just 30 days heading into this print. That kind of run-up, it tells us investors are positioning for a massive Q1. It sets a remarkably high bar. Honestly, even a strong beat might not be enough if their future guidance disappoints. Because a 41% climb in a single month means perfection is essentially already priced in.
But hey, the consensus isn't entirely bullish, right? We actually just saw the first major Wall Street downgrade in this recent rally. DZ Bank slapped a sell rating on the stock on May 19th, specifically citing massive valuation risk. I mean, when you're trading at 38 to 45 times enterprise value to sales, meaning the market is valuing the entire company at up to 45 times the revenue it actually brings in, there is practically zero room for execution errors.
So here is our earnings prep roadmap. We'll start with the high-stakes setup, move into the Falcon Flex engine, examine their post-outage resilience, break down the emerging threats, and finally, give you the ultimate earnings scorecard for June 3rd.
All right, Section 1, the high-stakes setup. Let's look at exactly why beating the bar is so difficult this time around.
The tension we're looking at is brilliant. You have management's official guidance, which is a very precise $1.36 to $1.364 billion for Q1 revenue, but then you've got the trading market's aggressive expectations. Polymarket traders are pegging a 51% probability that Q1 net new annual recurring revenue, or ARR, blows past $225 million. Remember, CrowdStrike has beaten consensus revenue 8 of the last 8 quarters and ARR guidance 7 of the last 8. So beating the estimate isn't really the story anymore. The story is how much they beat it by.
Moving right along to Section 2, the Falcon Flex engine. Let's see how this builds into the company's valuation.
To really grasp that valuation, we have to look at their secret weapon, which is Falcon Flex. Now, what is that? It's basically a flexible commercial structure that allows customers to consume a pool of products under one single contract. And why does this matter? Well, it completely removes the friction of adopting new modules. If a CIO wants to add cloud workload security or identity protection, they don't have to go back through a grueling procurement process. They just draw from their existing pool. It's a game changer that creates massive customer stickiness and consolidation.
And let me tell you, this structure fueled an absolute explosion in growth. Falcon Flex ended FY26 at $1.69 billion in ARR. That's a 120% year-over-year surge. It's the primary engine driving their net new ARR, pulling from existing customers rather than constantly having to hunt for new logos. The massive question for June 3rd is whether they can maintain this triple-digit growth at such a massive scale. Now, the foundation that actually makes Falcon Flex possible is the architecture itself. Unlike Microsoft Defender's clunky multi-component setup, CrowdStrike uses a unified single-agent approach. It handles endpoint, cloud, identity, and data security, all from one lightweight codebase. The financial value proposition here for a company is a total no-brainer. Replace 4 to 6 separate, clunky point security tools with one streamlined CrowdStrike contract.
Okay, Section 3, the post-outage moat. Let's see how their resiliency has truly been tested.
Because let's be real, we absolutely cannot discuss CrowdStrike without addressing the elephant in the room. Back in July 2024, a faulty Falcon sensor update crashed around 18.5 million systems globally. It was literally the largest IT outage in history. The estimated financial damage was a staggering $5.4 billion. This June 3rd print is essentially the second full-year anniversary check on the fallout from that massive crisis.
But here's the real shocker. Despite the unprecedented severity of that event, gross retention stayed remarkably high, at over 97% in the quarters following the crisis. It dropped by less than half a percentage point. This completely shattered the bare thesis that the outage would cause mass customer flight. Retaining your customer base through a category-defining brand crisis like that, it proves they have one of the most defensive moats in all of cybersecurity.
However, we do need to look at the full picture here.
because the aftermath isn't totally invisible. Management actively flagged that the July outage caused elongated initial sales cycles because new customers suddenly required way more due diligence. Existing customers added procurement friction to their expansion deals. Plus, you have the regulatory and legal overhang, highlighted by a pending Delta Airlines lawsuit estimating $500 million to $1 billion in damages. So we really need to hear on June 3rd if these sales cycles have finally normalized.
That brings us to Section 4, Emerging Threats and Bears. Let's dive into the intensifying competitive landscape.
So, a massive new battlefield right now is agentic AI, and for CrowdStrike, their weapon of choice is Charlotte AI, an embedded assistant that handles autonomous investigation, triage, and threat hunting. The real so what behind this technology is purely financial. It's a structural opportunity to replace the $30 to $50 per seat Human Security Operations Center, or SOC, analyst labor costs with an autonomous AI agent. If they successfully commercialize this, it creates an entirely new revenue layer beyond traditional endpoint protection.
But, and this is a big but, CrowdStrike is far from alone in this race. Just consider the heavy hitters moving in. SentinelOne is pushing Purple AI. Palo Alto has XSIAM, and Microsoft has Security Copilot. SentinelOne even has a similar single-agent architecture. The competition in this agentic AI category is becoming incredibly fierce.
And that leads us to the core of the bear argument: structural pricing pressure. Microsoft's security business is a $20 billion behemoth. And here's the kicker. They ship Defender for free with Windows licenses. They can literally pursue the market at zero incremental cost. As Microsoft's technical capabilities improve, the willingness of mid-market and SMB segments to pay a premium for CrowdStrike starts to compress. It is a highly asymmetric battle.
Finally, Section 5, the earnings scorecard. Let's see how all of this builds into the climax of our analysis.
If you're tracking the June 3rd showdown, these are the 5 specific metrics Wall Street absolutely needs to see delivered to justify that sky-high valuation we talked about earlier. Step 1. They need net new ARR to break $250 million, beating the Polymarket odds. Step 2. Falcon Flex must maintain that triple-digit growth at scale. Step 3. We need explicit confirmation that sales cycles are back to pre-outage speeds. Step 4, real, measurable commercial metrics for Charlotte AI. And Step 5, forward guidance that keeps the long-term dream alive.
And what exactly is that long-term dream? Well, everything hinges on validating this one massive number, a $20 billion FY36 ARR target. That's the public commitment management has made. To get there from their current ARR base of roughly 4.2 to 4.5 billion, it requires approximately 7 to 10 times growth over the next decade. Execution consistency is the only way a market grants a credibility premium for a target that large.
Which leaves us with the ultimate question as we head into the print. Does CrowdStrike's execution on June 3rd prove this ambitious 10-year goal is realistic? Or will the immense weight of Microsoft's free bundling, that intensifying AI competition, and a technically flawless valuation standard just drag them down? Keep these metrics top of mind as the numbers cross the wire. Thanks so much for joining me on this explainer, and I'll catch you next time.